Capital budgeting. Capital budgeting revolves around capital expenditures, which include large inflow and outflow of money to finance investment projects. It is a process by which a company decides whether it should invest in a project or not. Capital budgeting is a technique of evaluating big investment projects. There are various capital budgeting techniques widely used in the finance arena. Capital budgeting techniques according to discounting cash flow are: net present value, benefit to cost ratio, internal rate of return. Capital budgeting techniques according to non-discounting cash flow are: payback period, accounting rate of return, net present value. Net present value technique is a well-known method for evaluating investment projects or proposals. In this technique, present value of all the future cash flows, whether negative or positive, are calculated using an appropriate discounting rate and added. From this sum, the initial outlay is deducted to find out the profit in present terms. If the figure is positive, the techniques show green signal to the project and vice versa. This figure is called net present value, NPV. Example: suppose our proposed investment is $100 million and present value of future cash flows come to be $120 million. The NPV would be $20 million and hence, the project should be undertaken. If the PV is $80 million, the NPV would be negative $20 million, the project is not advisable in this case. Benefit to cost ratio presents the analysis in a proportion or ratio format. Here, just like in the NPV method, the present value of future cash flows is calculated and a ratio of the sum to the initial outlay is seen. If this ratio is more than 1, the project should be accepted, and if it is less than 1, it should be rejected. Let us assume the same example as taken in NPV method. Benefit to cost ratio would be 1.2 in the first case, and as per the rule, the project should be executed, and in the second example, the ratio is 0.8, which is less than 1, so the project should be rejected. Internal rate of return. This method is also a well-known method of evaluation. This has a severe connection with the first method, that is, net present value. In the NPV method, the discounting rate is assumed to have known to the evaluator. On the contrary, the rate of discounting is not known in this method of internal rate of return. IRR is found out by equating the NPV equal to 0 with an unknown variable as the discounting rate. This discounting rate is found out using trial and error method or extrapolating and interpolating methods, and it is known as internal rate of return. For evaluation purpose, IRR is compared with the cost of capital of the organization. If the IRR is greater than a cost of capital, the project should be accepted and vice versa. Payback period. It is the method of evaluation where no discounting of cash flow comes into play. The term payback period is the period in which the initial outlay is covered with the revenues. Suppose an initial outlay is $100 million, and the revenue stream is $40 for the first 4 years. Then, the payback period is 2.5 years. Essentially, in 2.5 years, the entrepreneur gets his investment back, and revenue after this period is the profit for him. Accounting rate of return. Accounting rate of return is calculated with the help of accounting data. The ratio of profit after tax and book value of investment is the accounting rate of return. If the book value of investment is $100 and profit after tax is $25, then the ratio results into 25%. Hence, accounting rate of return is 25%. Thank you. Please subscribe, like, and share our video.